Heading to Kenya now, the country has started selling a 65% stake in its state oil pipeline firm, KPC, and that's as the government looks to raise $825 million in what will be East Africa's biggest ever initial public offering. Now, the sale is part of a privatization drive by President William Ruto. It involves divesting from state companies to raise funds for new infrastructure and sovereign wealth funds. It is also reducing its stake in telecoms operator Safaricom. The government has priced that IPO with KPC in Kenya, a pipeline company, at 7 US cents per share. The sale will run until February 19th, and the shares will be listed for trading on the Nairobi Securities Exchange on the 9th of March.
When we talk about valuation, we are talking about a process that is fairly transparent, that is backed by methodologies with certified experts within our firms, and also market sounding. That is, informally actually reaching out to the market and trying to understand, where the market will sit from a professional investor standpoint. Okay, and with that, then we submit a formal report to the governing organs of the transaction that would, ultimately approve our proposed valuation. That is also reviewed by the Capital Market Authority of Kenya. So in a nutshell, it's been a process. But then again, looking at Kenya Pipeline Company, we're talking about capital intensive business, all right? And EV/EBITDA, which is an enterprise valuation methodology, is what was used, looking at the free cash flow, because as you know, the lower you go to the bottom line, the higher the likelihood of manipulating earnings, looking at the differences in accounting policies, but also the capital structure of these particular companies. We thought it would be important to look at an enterprise value methodology, and EBITDA really captures that. Okay, so the basis for setting the price is EV/EBITDA, and then it means it's a relative valuation. Looking at peer companies, we looked at India and the developed markets, and then we looked at the median where they were trading at, and you adjust for the margin and growth because KPC is unique. And ultimately, I will say that this was actually offered a discount of those peers.
And very quickly, I just want to get a sense of what it was about this company that led you to that valuation. Is it when you propose it to investors? What is that value proposition?
The value proposition of KPC is sitting on many fronts because you have a mature asset. We're talking about 52 years of existence, enjoying monopoly in this country when it comes to pipeline business, which is now the transportation and the storage of fuel. At times there's a confusion as to what exactly KPC does as a company. You see people comparing it with our oil marketing companies, for instance, or even our KPLC or Kengen. But I will say that the uniqueness of this business is at the interface of energy and logistic, because pipeline business means they transport, they store, and we've seen high margin. This is a very high margin business. If you look at our companies operating locally, oftentimes we talk about KPLC, Kengen, and others. The EBITDA margins are not what we've seen with KPC, all right? Because even in terms of net margins, the net margin of KPC standing at around 20%, on the financial year 2026, is probably what you would talk about when you talk about EBITDA for other firms. So really, to summarize for you, we're talking about a monopoly, we're talking about a mature asset, we're talking about high margin, and also growth prospect.
Right, and that's probably why analysts are saying there's going to be significant interest. Of course, this opened yesterday. I don't know what you've seen so far, but for retail and also institutional investors, there will be significant interest. I'd like to get a sense of how you're ensuring that the way this IPO is structured, there's a fair process to allow all investors access.
Excellent. That's a very good question, Uche. Thank you very much. To reaffirm that an initial public offer is a highly regulated process in our capital markets.
Right.
This is a process regulated by the Capital Market Authority. We are guided by the Public Offer Listing and Disclosure Regulation 2023, and specific to the Schedule 6 of those regulations, we are expected to make certain disclosures in what we call the Information Memorandum that has been released as at yesterday. And the transparency that is required in an initial public offer means that there is no preferential treatment to any investors. Right. And for those reasons, the allocation policy across investor pool is a requirement. And if you look at the information memorandum, you'll find that that information has been provided, to the general public, where we're talking about, allocating specific, percentages to specific category of investors. I want to take the opportunity, perhaps, to talk about that particular allocation, where we're saying the retail investors in this country, the local retail, have been allocated a pool of the 65% offer shares. We're talking about 20% allocated, to the local retail investors. Again, the same 20 is allocated to our local institutional investors. Okay. And then the oil marketing companies that are key stakeholders to KPC have been allocated 15%. Employees of KPC have been allocated, an investment pool of 5% of the 65%. And then we're also talking about the regional investors. As you know, KPC operates regionally, with transit market, forming 52% of their revenue, Uganda being a significant part of that. So regionally, we've allocated 20% of the investment pool to our regional investors. And last but not least, the foreign investors have equally been allocated 20%. So just to summarize that, we're talking about, employees at 5%, the oil marketing companies at 15%. So those are the stakeholders. That makes it still the 20%. And everything else is fairly distributed, is fairly balanced. And that really calls for, a fair, transparent, equitable, and inclusive process.